Are you a successful investor? Today's topic is 7 rules of successful investing. Hi, my name is Anuj Gupta. I'm an entrepreneur, mentor and advisor. I'm the founder of Tag Investments, a wealth management and taxation services firm having over 10 years of financial domain experience. We are licensed and registered with IRDA, Insurance Regulatory Development Authority, SEBI, Securities Exchange Board of India, MCA, Ministry of Corporate Affairs. Well, we'll start with the first rule of successful investing. Asset allocation. Studies reveal that asset allocation is the single most factor for successful investing, meaning that you should be invested diversely into various asset classes, namely debt, equity, real estate, cash, gold, and so on and so forth. Asset allocation also means that just by diversifying your portfolio, that's not the end of the game or successful investing. What it means is, if you invest 10% in equity and if that 10% equity does well, it does not mean that you're successful in investing. You should appropriately invest as per your goals and as per the asset allocation rules. Like a 30-40% in equity, 30-40% in debt, 20-30% in real estate. Second, keep it simple. Well, investment rules, so successful investors, they keep it simple, meaning that they save regularly, they invest for long term, they track their investments. However, as simple as it may sound, it's not very easy to follow. Third, any investor should have financial goals. Investing without goals is meaningless. It's like sailing in a ship without any destination in mind. You will be nowhere. So somebody might argue that I already have planned for a child marriage, I have some retirement corpus by virtue of PF, but that's not it. You should have investment goals. Maybe like I want to create 100 crores in 20 years or in 30 years. So that's also a financial goal. So at least you know what path to follow. Fourth, investor behavior. So one would have heard about greed, hope, fear cycle. So typically one invests when the markets are high and sells when the markets are low. Think about it. You should be doing it opposite, which means you should be buying when the markets are low and sell when the markets are high. But we generally follow the herd mentality and we end up buying at high and selling at low. Fifth, one should have a good financial advisor. Mind you, good. So a good financial advisor can help you, suggest you, be a mentor, guide to you in terms of making a financial plan for you, helping you with the financial goal settings, helping you execute the financial goals on the operational fronts, keeping track of the financial portfolio and also rebalancing the portfolio timely and helping you in the entire journey of wealth creation. Sixth, equity. Equity in the long term has proven to be the best asset class so far. History shows that in last 40 years, somebody who's invested 1 lakh, the wealth would have grown to 3.7 crores, which is 370 times, whopping 370 times in 40 years. So here the debate is not that who's going to stay invested for 40 years. Here what we are trying to prove by this 370 times 370x figure is that equity does make money and it's the best asset class to stay invested in. So one should have equity exposure in their portfolio for successful investing. Seventh, mutual funds. So whether it's the beginner or whether you are an amateur or whether you have become an expert into investments, one should have mutual funds into their portfolio for the simple reason it's already a well diversified kitty with you having nothing to do at all. Just stay invested in mutual funds and you end up making money in the long run. So that was the 7 rules of successful investing. Do follow the 7 simple rules of successful investing and become a wealthy investor. See you.